So what are assets, liabilities and capital or owner's equity that form statement of financial position? Assets. Something valuable owned and controlled by business. So it's anything owned by a business having a value. Assets can be divided into two main categories: non-current assets and current assets. Non-current assets are simply those which are held for a long period of time, that is over a year, whereas current assets are those held for a short time, that is less than a year. Non-current assets can be further categorized into tangible non-current assets and intangible non-current assets. Tangible non-current assets are physical objects. You can touch them, you can see them, like office buildings, plant, and machinery, vehicles. Intangible non-current assets are without physical substance. It means you cannot see or touch, but it has a monetary value. Examples are goodwill, trademark, copyrights, patents. Current assets. Now let's look into this. I'll give you a few examples. Inventory are goods manufactured or purchased for resale. So goods for resale is inventory. Cash in hand or cash held at bank. Receivables. It's money owed. As the name suggests, it's the money to be received. For example, I'm a business and I sold goods on credit to my customer. So they have to pay me in future. Therefore, the money owed by credit customers are receivables. Prepayments. Prepayments are payments in advance. It means expense hasn't been incurred, but you paid in advance. For example, rent prepayment. You haven't lived in a property yet, but you paid in advance. That's a prepayment. Liability. A liability is something owed by business to someone else. So, it's the amount owed by the business to anyone except for the owner of the business. Same as assets, it can be divided into two main categories: non-current liabilities and current liabilities. Non-current liabilities are due to be paid over a year. It means 12 months after reporting date. For examples, loan to be paid over a year, that is long-term loans. Current liabilities are due to be paid within a year. Now I'll give you some examples of current liabilities. Trade payables. It's the amount to be paid in future to credit suppliers. For example, you purchase goods, so any amount owed to credit suppliers for those goods purchased. Bank overdraft. It is the facility given by bank. Money is withdrawn from bank in excess of your deposit. For example, you deposited $1,000 in bank, but bank allowed you to withdraw $1,100. So there is an overdraft of 100. Bank would show a negative balance of 100. So you put in bank $1,000, but you took out 1,100 out of the bank, and 100 would be bank overdraft. What's next? Loan. Short-term loans which are payable in 12 months. Then you have accrued expenses, also known as accruals or outstanding expenses. These are expenses incurred but not yet paid. For example, you have used your phone, you made several calls during the month, but you haven't paid for it. you have to pay after the month end. So these are accrued expenses. Now moving to capital, it is the total amount invested in a business by the owner. So it's the amount owed by business to owner. It shows the owner's stake in business. Now we'll see what increases capital and what decreases capital. It will increase by any new capital injected into the business and by the profit made by the business. It will decrease by any amount withdrawn from the business by the owner, also known as drawings. So two things increases capital: new capital introduced and any profit made by the business, and decreased by drawings.